Hello and welcome to this new edition of EcoTV, your magazine tailored by BNP Paribas Economists. On the menu of this June edition, the love and hate relationship between central banks and financial markets. This is a topic developed by Chief Economist William de Vijlder. Next, the chart of the month is the US GDP growth. A contraction has happened on the first quarter. Is this sustainable? We're going to talk about that with Alexandra Estiot. Last, we go to Central Europe with Anna Dorbec. 3 questions on the growth sustained by the European budget. Between central banks and markets, the relationship could be either love, either hate. William de Vijlder, hello.
Hello.
You're Chief Economist of BNP Paribas. What is the situation now between the Federal Reserve, the ECB, and the markets? Are we in a situation of a love relationship or a hate relationship?
Well, it has cooled down a bit. It has been very warm for a long time, and now it has cooled down a bit. And that's related to recent statements made by Janet Yellen and Mario Draghi. Janet Yellen back in May has stated that she was of the view that the valuation of the US equity market was a bit on the expensive side. And more recently, Mario Draghi has said that, we simply have to live with increased volatility, which means that, tough luck, you just have to accept it.
How was it in the past? It was better.
It was better, and it was better except for one element which has gone down in history. The famous speech of Alan Greenspan back in December 1996, in which he was saying that the US equity market was in a state of irrational exuberance, which, by the way, did not stop the market from continuing to rise for another 3.5 years. But no, more recently, what we have seen is that the relationship was very intense, and that is not a surprise. Central banks have been easing policy and then quantitative easing, and they both liked each other very much, so to say. Central banks like markets because markets give information on whether the central bank policy is credible, what the expectations are in terms of future evolution of growth and inflation. More importantly, central banks use markets. This is very important. They use markets as an instrument, as a tool to influence the economy. If they cut interest rates, typically stock markets go up, bond yields go down, funding for corporates becomes less expensive. So these are actually the channels of transmission to boost economic activity.
But in the two sides, sometimes we can spot on some frustration. Can you explain us this?
Yeah, if you look at markets, it's as if you get a present from your lover every week, and that's fantastic, of course. Now, of course, if you get less frequent presents, you have to say what's happening. And this is now what we have reached as a stage in the business cycle. So the tone from the central banks is becoming less positive, less friendly. The frustration from the central banks is that they may be of the view that markets have become a bit too expensive, but it's very difficult to do something about it. Can you be mathematically sure that they are too expensive? No, there's no way to pinpoint that. Secondly, even if they would be of that view, it's very tough to do something. And why is that? Because if the tone that they would use would be too aggressive, there is a risk that would cause a big market correction and hence trigger negative consequences for the real economy, which they want to avoid at all costs, of course.
And how could we measure the effectiveness of this communication between central banks and the markets?
Well, you can look at it, you can look at the effectiveness of the impact simply by looking how much do markets swing around. Does it have a long impact? When Yellen says something on the US equity market, does it have a lasting impact? No, it didn't. When Greenspan was talking about irrational exuberance, it had a market impact for about 1 day. Interestingly, Mario Draghi is another story because he was very clear about this increased bond market volatility. And what it really means is that he's kind of sending a signal to the market that, well, we looked through these bond market volatilities, so we accept it, and as a consequence, you have to accept it, which also means do not expect anything from our side that would soften that volatility.
Last question, what is the outlook of this relationship? Do you think it's going to warm up again?
Well, I think it will stay where it is now, and that is related to the stage that we have reached in the business cycle. What the Fed wants to make sure is that the market understands that there will be a rate hike, but it's also that the market is not getting paranoid about how important there would be a rate hike. So in a way it wants to kind of become a bit tougher whilst not whilst not demoralizing the markets. And if you look at the side of the ECB, there the message is very simple. They will continue with the quantitative easing. If the market jumps up and down for a host of reasons, okay, that's life, and we as investors, we have to accept that.
Thank you very much, William de Vijlder. Next, the chart of the month is about the US growth. We're joined by Alexandra Estiot. For the graphic of the month, we focus on the US growth. Alexandra Estiot, hello.
Hi.
The GDP has contracted on the first quarter, minus 0.7%. We thought that the recovery was on in the US. Are you worried now?
There are both reasons to worry and reason for comfort. As for comfort, the thing is that we have had temporary factors driving down the activity in the US, with both a harsh winter, especially in the northeast of the country, but mostly the strikes in the West Coast that disrupted the production chain. So these are two main reasons behind the contraction of GDP.
So now why is the growth so fragile?
Well, it is very fragile, as you say, because the output gap remains quite large in the US. The output gap is the difference between potential growth and observed growth. So what we can see on the chart is that when you have a recession, the output gap is enlarging. The latest recession was particularly harsh, so the output gap went down to almost 8% of potential GDP. That's huge. Since then, the recovery has been slow, and even if the output gap has been narrowing, it remains relatively large. As you can see, it's above 2% of potential GDP, and in fact comparable to the worst situation following the previous recession.
At the end of the day, do you think that the actual recovery in the US is hiding something more worrying?
Well, to answer this question, we need two other curves, which are the potential GDP and the actual GDP. So potential GDP is when you fully use production factors, capital and labor. This is what you manage to produce. And actual GDP is what really happened in the real life. As you can see on the other chart, is that with a recession, we have a widening of the output gap and then a slow narrowing. And that didn't finish the job. But what you can see as well is that the narrowing period has been very lengthy. As you can see, last time it took something like 3 to 4 years. Now we are 5 years after the end of a recession and still with a large output gap. And actually, one of the problems behind this is a slow narrowing tends to lower the potential rate of growth. And this is actually what happened. Before the recession, the potential rate of growth was quite fast. And as you can see, with the recession, we have the curve moving downward, illustrating a slower rate of potential growth. And what happened is that there was not enough investment to feed up labor productivity gains, while the fertility rates have been going down in the US.
Last question, what is your prediction for growth in the US in 2015?
We don't really expect any kind of rebound, meaning that we're going to keep the same slow growth pattern of between 2 and 2.5%.
Thank you very much, Alexandra Estiot.
Welcome.
Next, 3 questions to Anna Dorbec. We're back to Central Europe. Stay tuned. Looking for growth in Europe, we go to Central Europe. 3 questions to Anna Dorbec. Hello, Anna.
Hello.
Anna, first question, what is the engine of the growth for these countries who have between 2 to 3.6% of GDP growth?
In fact, the countries of Central Europe are surprising us with the interesting growth rates, which are above the average of the European Union. The growth is driven by domestic demand. It creates jobs, with the unemployment rates declining in all the countries, and it is non-inflationary, with zero inflation rates in all of them.
So, second question, what about the monetary policy?
We would think that monetary policy would be an engine of growth for these countries, but the trends are very uneven. In fact, the credit is supporting growth in Poland and Slovakia, but it is slowing down in Czech Republic and declining in Hungary, despite the historically low interest rates.
Third question, is the fiscal policy an engine too?
Of course. First of all, the countries are now ending the fiscal adjustment, notably with the end of the excessive deficit procedures for Hungary 2 years ago, last year for Czech Republic and Slovakia, and very recently for Poland. But still, the countries are concerned to maintain their deficits under control, which allows them very low room to maneuver.
What about the European help then, the contribution? Is it a good point?
The inflows from the European Union increased substantially to reach 5% of GDP for Hungary and 3% of GDP for Poland, for instance, last year. So the support is sizable, and the country's capacity to absorb the support increased a lot. And the low interest rate environment facilitates the projects in co-financing.
And for 2015?
So we say that the European budget is compensating somewhat the absence of the leeway from the national budgets. And the situation is expected to remain this way for this year, but we expect that national budgets will regain their importance in the years to come.
We'll monitor that. Thank you very much, Anna Dorbec. See you next month for our summer edition of EcoTV.
BNP Paribas, la banque d'un monde qui change.